Brace yourself. This week's economic report could shake up your finances in ways you're not expecting. Thursday's release of the August Consumer Price Index CPI data is about to drop, offering Americans a clearer view of the economy's trajectory. This report isn't just a dry number. It's a window into whether your grocery bills, rent, and medical expenses will keep climbing or finally stabilize. And here's the twist. This data arrives just days before the Federal Reserve's critical decision on whether to slash interest rates in September. The stakes? Your savings, your mortgage, and the cost of everyday life. The CPI tracks how much a typical basket of goods and services costs, including things like groceries, rent, and medical care. Economists predict August's numbers will show a 2.9% annual price increase, up from 2.7% in June and July. Combine that with Wednesday's Producer Price Index, CPI, of 2.6%, and it's clear. Inflation is still outpacing the Fed's 2% target. While prices have cooled from the 9.1% spike in June 2022, they've still risen nearly 9% since July 2022. That's not just a statistic. It's 9% more you're spending on essentials, squeezing household budgets tighter than ever. But here's where it gets tricky. The Federal Reserve has a dual mandate: keep prices stable and ensure full employment. Right now, those goals are at odds. Job growth has slowed, and unemployment is ticking upward. New York Fed President John Williams calls this a challenge, and he's not alone. Bankrate Stephen Cates calls Thursday's CPI report one of the most consequential of the year, warning that if prices for essentials like groceries and utilities accelerate, it could spell trouble as the labor market weakens. It's a perfect storm, Cates explains. Higher costs meet slower job growth, and families feel the pinch first. So, what's the Fed going to do? Despite the inflation worry, markets are betting on a 90% chance of a 0.25% rate cut in September, per the CME FedWatch tool. That would bring the benchmark rate to 4% to 4.40%, lowering borrowing costs for credit cards, car loans, and mortgages. But here's the catch. The impact won't be immediate. Credit card rates might dip within a few billing cycles, but auto loans could take months to adjust. Early savings might be small, just a few dollars off your monthly credit card bill. But they'll grow if more cuts follow. Fed Chair Jerome Powell has called the current 4.25% to 4.5% rate restrictive, and with the job market slowing, a cut aims to prevent a deeper slowdown. Christopher Waller, a Fed governor, backs this move, noting the labor market has come in much softer. He even hinted at a potential rate cut at the next meeting. "I don't see a recession in my forecast," he said, but slower growth is on the horizon. And this is the part most people miss. Waller also argues tariffs might only cause a one-time price surge, not lasting inflation. But is that really the case? Could tariffs really be a one-time hit, or are we setting up for long-term inflation? Cates warns that future cuts are far from guaranteed. If CPI reports keep surprising on the high side, he says, the Fed might pivot back to fighting inflation. Ready to take control of your professional future? Sign up for CNBC Make It's new course, How to Build a Standout Personal Brand, and learn how to create a digital presence that AI can't replicate. Plus, join our exclusive LinkedIn community to connect with experts and peers. Your next career opportunity might be just a click away.